Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from the SALT Conference in New York City. Joining me for this segment, we have Sarah Samuels, Partner and Head of Investment Manager Research at NEPC. She joins me to discuss managing liquidity in today's environment. Sarah, it is great to have you with us. Welcome to TradeTalks.
Thank you. It's a pleasure to be here.
So we know the liquidity environment is somewhat challenging as the markets are evolving. How are clients managing through liquidity needs in today's environment?
So our clients are doing okay. So at NEPC, we help over 400 clients invest in the private markets. And so we're overseeing about $1.5 trillion in capital. And these clients vary from endowments, foundations, to public pension funds, to healthcare institutions, and anything in between. And what we're seeing is that from a liquidity standpoint, many clients are pulling back a little bit on the dollars that they're putting to work in the ground, but they're still active in the private markets. So we are seeing them continue to commit. What I see as potentially a challenge is 2 or 3 years out, when everything that could have been sold has been sold and returned to LPs from the private market GPs, and looking at what we have left in portfolios at that time. Now, the other thing about liquidity in today's environment is that cash is yielding again, and our clients can get a pretty great risk-adjusted return by keeping some more money in cash and creating that buffer for, as an anchor to windward should we have a turbulent time period.
So let's talk about valuations for a moment. Have we seen the end of markdowns and down rounds and so forth?
So I think it really depends on each GP that we're talking about. So valuation policies can really differ widely from one GP to another. And so one of the things that could be a bit of a pro tip, I guess, if you will, is to take a look at the underlying portfolio company holdings in your portfolio and see where they're marked. If they're marked below the last round financing, you can expect that there won't be meaningful markdowns in the future. If they're held at the last round financing, especially in your venture portfolio, it's likely that that next round, when it's raised, is probably going to be down.
So would you say that now is a good time to deploy capital into new investments as valuations are more attractive than they may have been a couple years ago?
Absolutely. It's a wonderful time, historically speaking, when we look at phases of the cycle like this, to put dollars to work. So we're really excited about putting new dollars in the ground in private markets, as well as other areas, whereas we might expect some markdowns in the investments that are already out there.
Right. Would you say the valuation reset was almost necessary to stabilize or get back to some sense of normalcy?
Absolutely. It's very healthy and it's absolutely required. And this has been a really long cycle where we haven't seen as many resets as we normally would. And so this is becoming quite extended, and there needed to be and may still need to be a bit of a reckoning.
Where do you see the most opportunity in private markets?
So we really like the early stage venture side. We still think those evaluations are attractive, and there are great portfolio companies and GPs out there. So we're talking seed stage, we're talking Series A. We also see opportunities for lenders for becoming a provider of capital in this environment, because banks have really stepped away. And so you can make a pretty decent return unlevered in many private debt strategies, so long as you're careful about the partner that you choose and that you choose someone who has workout capabilities. And we also see opportunities in providing debt in the real estate space.
It's interesting because we're hearing about private credit so much more, certainly over the past 12 to 18 months. Would you say that's almost a crowded space at this point, or what would you be looking for in a private credit investment?
So we're looking for a team that's been through a cycle before. If you think about how long and protracted this cycle has been, anyone under the age of 38 really hasn't lived through a major market correction or a downturn or recession. They might have lived through some spurts, some mini cycles, but we really want to see that there have been people on the team who have lived through this before and have experience in these types of environments with cycles of distress. And then we also want really robust workout teams and capabilities with a proven track record.
That's why I was asking you about the valuation reset, because there are a number of private companies out there, let's call it even the past 10, 12, 13 years, where interest rates were so low, the system was so flush and so liquid, and they've only seen the market go from the bottom left to the top right. This is a big learning experience for them.
Big learning experience, and it's important that there are senior advisors that are elbow to elbow with people touching the capital, both on the client, the LP side, and the GP side.
All right, appreciate the insight, Sarah. Thanks for joining us on TradeTalks. And thanks for joining me from SALT. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.